thank you so much for our sponsors. We're going to start out with Dowden Mortgage Group. Tom is a friend of mine. He wanted me to say this about his company. He just started here locally. He's a local lender. I can't speak enough on the point of using a local lender. The Dowden Mortgage Group is NMLS number 2636880. They're an equal housing lender. The Dowden Mortgage Group is a boutique mortgage brokerage founded right here in Fayetteville, Arkansas. When it comes to understanding market events and technical indicators that impact mortgage interest rates, we pride ourselves in being one of the most informed and knowledgeable lending partners in the country. Tom Dowden is a top loan officer in Northwest Arkansas who has worked to help clients acquire and leverage real estate to build wealth and maximize retirement for over 15 years. His reputation is built upon providing expert financial advice to his clients, real estate agents, investors, and other financial advisors. Before founding the Dowden Mortgage Group in 2024, Tom worked for one of the top investment banks in the country, leading their ultra-high net worth lending division for the Pacific Coast. In 2019, he achieved personal production of $167 million in funded loan volume, making him one of the country's top mortgage originators. Tom moved to Northwest Arkansas a few years ago and is excited to bring his knowledge and experience to his community. His talent is advising clients and families on the best way to build personal wealth through home ownership. Give him a shout anytime you need. His email is tom@dowdenmortgage.com. tom@dowdenmortgage.com. Thank you, Tom. Thank you for our next sponsor, Sky High Photography. This is somebody that I personally use for all of my listings for my clients. Any listing I get or any home that I need pictures on, they're the people to do it. They do great photography work. They have drone footage, videos, anything you need for your homes. I can't, I've used quite a few people in the business, and after using them, it's seamless. It's easy. If you're a realtor listening to this, I think they're a really, really good company to use. They have a really cost-effective price. It's simple. It's a text and a phone call. Hey, can you be here at this time and coordinate with the owner? And they say yes every time. They are great on scheduling. Their photos are just incredible. They stand apart from the market. So I can't speak highly enough on Sky High Photography. They do a great job. Colby Clark does a really good job running that. So I want to say thank you to Colby. And if you're looking for photos for your home, please use them. Our next sponsor is Tim Bishop with Longhorn Investment Arkansas in the Arkansas branch. They are a hard money lender, something we don't have a lot of here. They're a top hard money lender in our state, lending in 9 other states: Texas, Missouri, Tennessee, Indiana, Ohio, Alabama, New Mexico, North Carolina, and Georgia. They lend a lot in NWA and Fort Smith and Little Rock metro areas. They're a great product for getting things done quick. They offer fix and flip lending with zero down, up to 70% ARV, or up to 75% of ARV for BRRRR deals. The only cash to close is closing costs. They can close really quick in only 5 business days if needed. I think they're a really good product. I know some of my clients have used Longhorn Investments with Tim Bishop. He's a great contact for them. If you're needing some hard money, some creative financing in any of your real estate deals, I think Tim's a great guy to reach out to. You can contact Tim at 817-812-7187. He's a great, I've worked with Tim for a while, a personal friend of mine. I would highly encourage using Tim with Longhorn Investments for any hard money lending situations you may run into. So our next sponsor is Top Notch Specialties Garage Company. They are a professional custom shop here in Northwest Arkansas. They offer detailing services, paint protection, ceramic coating, window tinting, vinyl wraps, paintless dent repair, and much more. Feel free to stop by or give them a call at 913-250-9004. They're located at 4106 Honeysuckle Lane in Rogers, Arkansas. Luis and his team do a really good job over there. I personally use them for my car as well, getting some paint protection done. I got some dents on the front of my car, or some paint chips and things of that nature, and they got that fixed and did some paint protection. I've been in their shop quite a few times, and they have a lot of cool things going on. Wraps, detailing. They do great on window tint. Top notch. Specialties Garage Company is a great company. They're local here. Some really good guys, some honest guys. You want to do business with honest local people, and they are the embodiment of that. If you have anything you need for your car or truck, or even servicing vans or anything of that nature, anything vehicle related, give them a holler. Welcome to NWA Investing Podcast, episode 37. Thank you guys for being here with us. We have Brian and George with us with what's the syndication company as well?
Elevate Commercial Investment Group.
Yes. So we have some great people here to talk about kind of the multifamily space, getting involved with kind of some. We're going to look at national and more micro here locally, markets like that, and we're really excited to have them on. Let's just get right into it here. Let's just kind of go around real quick for the audience members listening who maybe don't know me or Brandon. Brandon, can you start us off and just give us like a 3-4 sentencer on like you, what you do?
Yeah, so just not too much about me, but Brandon's still a local agent and investor, and here in Northwest Arkansas, and been in the area for all my life, so know it well, and kind of excited to get going and hear Brian and George's stories. So
Brian
Wagers, here local to Northwest Arkansas. Been investing in multifamily for about 7 years now, and still buying multifamily, investing locally, nationwide, helping other investors invest passively in real estate.
Then George
Abreu with Elevate as well. Been investing in real estate full time for, I think 17 years now. And now focused on large multifamily apartments.
Amazing.
Awesome.
I'm Zach Stanley. Hopefully you know me by now. I've been in this area. My family's been in this area since the early 1800s. I've been doing real estate for 5 years. Invest, build a few homes, and then hopefully, if you're listening, you'll use Brandon or I to help you buy a home, buy investment property.
Yeah.
We're gonna therefore jump right into it with more of a macro topic discussion, which is like, what are you guys seeing in the multifamily sphere? I think Brandon and I will be able to talk more so on like small scale, like things 10 units and below, because we got a lot of clients looking in that sphere. And you guys are, of course, dealing with potentially stuff like that, but like most likely it's going to be your bigger 50, 100, 200 plus unit type things. And so, Brian, can you get us started on like what you're seeing nationally as far as multifamily deals? I know you guys just got through the due diligence period on one deal. What are you seeing nationally as far as like the ease of being able to find stuff, or like what the market's doing?
Yeah, I think nationally it is a lot different than us in NWA. We're on the NWA Investing Podcast. It is a lot different picture nationally versus NWA. You know, us here, we're seeing prices continue to go up. Seems like anything on market is hard to compete with. But we're seeing sellers' expectations come down a little bit. You know, they've been pretty high for a while.
Praise God.
Yeah, interest rates up, sellers' expectations still up. So it's really hard to get anything done because you're at this stalemate of, borrowing, is expensive, and then sellers still want their required equity multiple or what they need to do to exit a deal. So we're starting to see it come down a little bit, and developers particularly, that's become one of our targets. Maybe they overbuilt, or maybe they over leveraged, or maybe their equity wants out.
Right.
They thought they could sell at C of O, where right now, which is completion of construction. So developers will build it, and then once it's completely built, they'll sell it. But we're seeing a lot of times now builders are having trouble selling it at completion of construction because the financing for that has fallen off. You're looking at a lot lower leverage,
Mm-hmm.
a lot higher interest rate than you did, just 3 or 4 years ago. So your end buyer for that is having to put more equity in the deal, and they're not able to pay as much. So
Yeah.
now they're really having to push through lease up or get creative on
Yeah.
selling. So
So you're seeing this like come back to earth type of maybe a trend, which may,
Or maybe even a bailout, right? Or like a jump off the ship.
Yeah, I mean, I
Sellers.
think it's you're starting to see the sellers get more motivated for several different reasons, mainly loan maturity. So I think that's what's kind of driving that back to reality.
Yeah.
And it's been a tough 2 years or so. We've been submitting offers nonstop throughout those 2 years,
yeah.
but those offers haven't gone anywhere, mainly because the pricing, right? And now we're starting to see it. It's getting closer. We had rates come down a little bit, right? Which is another tricky thing. Is that as the rates start coming down, I feel like the pricing is going to start going back up again with multifamily. Still a lot of demand. So it's going to be tough.
Do you guys feel like your business operates in like windows of time? Like, do you feel like that sometimes we're like, okay, interest rates are trending down now, great, but that means prices go up. So there's this like random windows of time throughout pockets and seasons that you can, hey, we're sending out a bunch of offers right now. I think it's time to get stuff. And then also onto that, I think I'd like to elaborate further on the patience it takes for you guys on being able to say no, 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 and then yes. Like, and I love seeing your posts about all those units that you guys got through the due diligence period of, hey, this is our first deal of the year. I think that speaks a lot to the company and the ability to say for our potential investors, like, we're going to say no, we're going to throw out the offers to try to find the right things. We're not just going to say yes because we got the bug to get something. And I think that's what a lot of young investors do is they are like, I haven't bought anything in like a year, and start getting like this like drug itch to like just throw cash in the market. And so I guess speak on the ability to have patience in the last type of 2 years.
Yeah, I mean, look, I think it's huge if you want to buy a good deal, if you want to buy it at a right price, you got to have that patience. It is tougher when you're talking about a larger firm that has overhead and has payroll they got to pay, right?
Yeah,
all that kind of stuff. But you've got to have that patience and not just do a deal to do a deal.
Yeah.
Not that everybody has that. There are some groups out there doing some questionable deals as far as pricing, things that we just wouldn't feel comfortable moving forward on. But I mean, I think that the best deals are made in those windows that you talked about.
Yeah.
And I think this is one of those times where if we're not at the bottom, we're somewhere near it.
Yeah. You guys can you feel it in the air, you're like, I know deals are on the horizon. Is that kind of the feeling you get?
Yeah, I mean, you see it, right? When you see some of these sellers getting that motivated or willing to take a loss. I mean, we've seen a lot of that.
Yeah.
That's usually the time where deals are to be had.
Yeah.
Yeah.
You seen the same thing?
Yeah, and to your point about the window, it's like you don't know the bottom until it's already past you.
Yeah,
So that's part of the problem. But if you look at like Blackstone and KKR, they're making $10 billion bets that's already been at the bottom. So they're a lot smarter than me and have a lot more money than me. So you kind of watch that and see what they're doing. The windows for us, it's a 5-year window. Usually for us, it's a 5-year business plan for our deals.
Yeah.
Sometimes we're able to do that in 2 years, but for market cycles, it's really hard to say what the window is. So I'd say,
Which speaks to the ability, if you don't know what the window is going to be, just consistently putting in the work and consistently trying to find deals. And you don't have to know when the windows are because you're going to be active when that window approaches. Would you say that's correct?
that is 100. Yeah, our director of acquisitions and senior underwriter would agree with you there. I mean, he just said that the other day about we're buying deals that make sense today. We're not betting on the future. We're making.
Love that.
We're buying what works today.
Yeah. Speaking on that, in both of your times in real estate, have you seen the cycles kind of repeat themselves over time? You said 17 years for you and 7 for you, right?
Yeah.
So you've probably seen a few different real estate cycles. Are you seeing anything that's like this has happened before and this was a result of that, and are you acting like, in a certain way, or
Yeah,
or you just
yeah.
kinda
Look,
continue?
I actually think it's been 18 years. So 2006 is when
wow.
I started full time in real estate, and we had a good couple years, and then 2008 happened, and same things that are happening now, right? The not so many lenders willing to lend, hard to find deals or make sense of the deals, and I will tell you that we stayed active back then, and anything that we purchased from 2008, call it to probably, I don't know, maybe 2012 is when things started heating up a little bit more. All those deals were home runs, pretty
Yeah.
much.
Yeah.
So I don't know that yet about this one, but
Yeah.
I feel like anything that you're going to grab right now that you stay true to your assumptions and projections is going to be a good deal.
Let me ask you this. You said the word home run. Did you know when you're buying this is a home run, or did you think...
Absolutely not.
Or did you think this is a single, and
No.
then you're like, this is a single, maybe a bunt, and then you're like, this turned into a home run 5 years later. Is that kind of how it works out?
Yeah. I mean, we like we just said, right? It made sense at that time. It made sense with what the interest rates were, with how we were structuring the deal. But if I knew that's what it was going to be, we weren't raising equity back then, so I only had so much money.
Yeah.
But I would have bought a lot more deals for sure.
Well, and also if everyone knew it was a home run too, like it wouldn't have existed when it would have been 10 bids, like insane. So like you kind of, there's this fine balance of like, it kind of works, and then it like ends up work. That's how like some of my single family homes work. I was like, I don't know what I'm doing, like cash to the wind kind of thing, and then they ended up being great. And so we're speaking on a smaller scale, of course, but Brandon, I want you to talk a little bit on what you're seeing in kind of like 10, 20 units and below in the market. I think that's probably where a majority of our listeners will be at mentally thinking. They're not going to be, we're going to dive into further like, hey, like, why should someone think about like passive investing with you guys? But like for more of the active spot for some of our listeners listening and saying, hey, I got $200,000, I want to go do this myself. What are you seeing in that sort of multifamily realm? I know you've listed some recently as well too.
Yeah, it seems like it's one of the more competitive kind of areas in multifamily in Northwest Arkansas. At least you got a lot of these small investors that feel like they have enough capital to make a deal like that work. And so I think the big thing too, we don't have a lot of new development of that. At least what I've seen, there might be some coming, or there might be some that y'all are seeing, but I've seen a lot of just older, let's say 20 units or less that a lot of guys from out of state really are kind of coming in and finding opportunity, value add opportunity really, that are below market rents, and that they think that they can push up, especially in Fayetteville. A lot of that going on in Fayetteville. I'm sure y'all have seen that. So yeah, I think some of the projections that I've seen from investors on where they think rents can get, even in 12 months or 24 months, is pretty aggressive in my opinion. But I mean, I think it's just hard to tell. So
it's actually interesting. We went and toured a couple properties actually before we got here today, and they were a little bit older, large multifamily, which seems to be not very common in this area, right?
Yeah, no.
And I mentioned it to Brian, like it's, and he talked about the rents. You can't build that, right? You can't go and build something older, obviously.
Yeah.
And with a city like this that's growing, there's going to be a high demand for those older, because they're not going to be able to afford the newer product.
Correct.
So yeah, I mean, I could see that. I could definitely see being able to get a little aggressive with those rents.
Yeah, and one thing I really am trying to understand a little bit more, and y'all probably understand this really well, is replacement cost and what that looks like with new development and stuff like that. Can y'all give any insight on how that plays into what you're looking at on the large multifamily side, and then maybe how that makes sense for smaller investors to be looking at? I mean, you can't build something, small multifamily wise, less than 10 units that you could just purchase existing for the same price. So yeah, tell me how y'all look into replacement costs.
I mean, I'm seeing anywhere $160,000 to $200,000 a door, even above $200,000 a door is what we're seeing. Yeah, I'd say 160 very low end, and then right around 200 is pretty standard. Was what we're seeing like for new builds to cost.
That's
Wow.
crazy.
When you factor in everything. Yeah, so it's making it tough for to make sense of projects. You're seeing a lot of development projects stall. You're seeing a lot of planned development projects not actually break ground. Yeah, they had this envision of doing a couple hundred units, but they couldn't capitalize it. Couldn't make sense of the number. So definitely makes it tough. When you're looking at development, because development is something we're interested too. There's a lot of parallels with multifamily development and existing, but it's just it's hard to make existing deals pencil. It's even harder to make some of these development deals pencil. So
I think some of the stuff we've seen there too is I think Brian had mentioned where we've had a lot of success buying from developers. So something that was built maybe just a few years ago, and you can't build it for what they built it for. So now we can come in and buy it under that replacement cost, like you're saying.
It's crazy.
Are you catching these guys on like, hey, like please take this off my hands type of mentality?
Pretty much. I mean, they're not operators. They don't want to hold on to it.
Yeah.
And we do. We're good at that. We're good at maximizing the value, and they just want to get rid of them.
Yeah. I know a prediction, Kyle, you have these investors coming in with big aspirations for where the rents are going to go. Kyle's my principal broker. He also is a multifamily investor in the area. He thinks there's going to be a softening in rents potential in the next like year or 2 years. We've been having these like very high predictions over and over and over again. Like we can't find the ceiling, and it's like he thinks with owning a property management company and what he's seeing in the market is like. We are seeing like in the single and small multifamily, like a softening already in the rents a little bit because we've had these bold predictions for so long of like, well, this one got 1,600, you could probably get 1,850, and like they get it over and over again. It's like, okay, where's the cap? Like, are we going to start charging 2,500 for a single family? Like, it ain't going to happen. So he's like, there is a lot of caution to those listening, like, I just think that there will be a little bit, especially I know we're not talking about single family, but especially in the single family market, like we're going to see, I've seen investors where typically like it's like 5 days on the market, all my homes are filled. Now we're a month, we're 2 months on the market, and it's taking a little longer than normal, especially for the whole market as a whole. We're seeing that multifamily and single family. I would agree with you, Brandon, as far as the small multifamily goes. I've probably had, I want to say 30 deals like in due diligence period over the last 2 years, and none of them got to the finish line. Like it's been because it's a lot of like the buyer coming in and like, hey, let's just lock them in. Like, let's see if we can get them lower kind of mentality. And like, it never happens because the seller's like, well, I'll get 2 million sometime for these 5 units. And it's like, it's been really tough, especially for me to like, I'm trying to find something right now, like around 10 units to do a cost seg on so I don't have to pay the taxes. And so like I've been like busting my ass trying to find multifamily off market, on market, like all these sellers. It's just super like you spoke, George, like a lot of unrealistic expectations right now. I don't think for some of the small multifamily, I don't know if the pain point's there, and I don't know if these guys necessarily have. A lot of the stuff I'm going after, these guys like might even have it paid off. They bought it for like, I was going after a 10 unit and the guy bought it for like 350 or something like that. And it was like 20 years ago that he bought it. And like, he's like, I can't roll it into anything. What do you want me to do? And so I'm seeing it is very, very tough in this like older 10, 20 unit space. Let's jump into the deal that you guys just did. If I know it's pretty fresh on your mind, you just got through the due diligence period. What did that due diligence period look like for you guys as far as like potential hurdles you maybe had to overcome? I think the audience would be interested in if there was any hurdles, or was it smooth as butter?
It's never smooth. This one had some interesting. We haven't talked about it actually, but yeah, I mean, it had some interesting hurdles. Where
is this? And do you feel comfortable?
Definitely open the book. Yeah, it's in 144 units in Dallas.
Mm-hmm.
We're buying directly from the developer. One of our targets. It was built in 2023. So we just now release earnest money to say DD is done and we're good to move forward to a close. So there's 2 parts of due diligence. There's financial due diligence and there's physical due diligence. So financial, doing lease audits, making sure the renters are paying what it shows on the rent roll, figuring out what kind of tenant base is there, double checking all the financials, and then there's a physical, and that's where George and his team are very important. And one of the reasons why I partnered up with Elevate in the first place, was that construction background. You need that walking 144 unit apartment versus an 8 unit, 10 unit. You maybe could use your single family home inspector, and you could walk it yourself and see different issues. But we're just now through that, and I'll let George kind of talk about the physical.
Yeah, on the physical end, I mean, a lot of people get surprised when we tell them that this is a Class A building just built last year.
Yeah.
Like, oh, what are you going to do? What are you going to inspect? It's like, man, you just don't know. From one builder to another, they're not all the same.
Right, right.
For sure.
Totally.
So, I mean, we go in there, we run cameras in the sewer lines. We found a couple issues there, nothing too crazy. And we found some AC issues where the Freon levels were off, and then there was a couple other ones that just weren't working, and then balconies leaking. So that's always a big thing, especially when this is a modern looking build. So we found a couple balconies that had been leaking. So we were able to go back and forth and get a credit.
When you say that, what do you mean? Like a balcony leaking?
So look, when it rains.
Yeah,
when it rains.
Got it.
Yeah.
Yeah.
So it has a pitch, but the way it's flashed into the building was not done properly on these.
Got it. So there was definite hurdles to overcome.
There was, and that was just the physical part of it. We went back and forth, came up with a credit amount that we felt comfortable with. They took it, but then there was also the financial part, which Brian mentioned. So when we dug into, and I guess I need to go over the structure of this too. It's a little complicated.
Yeah.
But it's going through lease up, so it's not it's at like 60%.
Right, because they built it in 2023.
Correct. And we knew they weren't operators. They've been hiring third-party management companies, and you can tell from the reviews it's
Probably
been rough for them.
Yeah.
So we knew what we were walking into, but when we reviewed the financials a little deeper, it seemed like the occupancy, or it didn't seem, the occupancy was lower than what we had originally been told, and
crazy how that works.
Nothing that the seller, wasn't telling us fraudulently. They didn't know either. We just dug in a little further. So that was really the biggest hurdle, kind of going back and forth there, because we want to get it to a certain occupancy for us to close with a permanent loan.
Yeah.
But we worked through it. It was a rough, 2 weeks maybe? Actually, we extended the DD 3 times.
Okay.
Until we finally came to an agreement.
So how long did that period end up being at the end from start to finish? Was it like 120 days, 90?
No, so I mean it was 30 days in the contract, and then we extended it maybe another 2 weeks.
Okay, got it.
Yeah.
Well, that's not terribly long.
The whole contract will end up being over 120 days.
Okay,
But just the DD period was like 45 days or something like that.
Okay.
Yeah.
What did it look like? Is that on either of you guys, like verifying like leases, like, hey, here's our rent roll, we're getting $1,200 a unit, but like how do we verify that? What would that look like for you guys? Is that like knocking on a door and saying like, show me your bank account, or is that?
No, so I mean we do walk each unit.
Right.
So we do verify the condition, and if somebody's
you walked 144 units.
Correct.
That's wow.
Not just me, but
the
team did.
You specifically.
So we do that. Then we do verify each lease. We audit. We do a lease audit.
Yeah.
And then the delinquency is where we saw the difference on this one. It seems like the report that was initially given to us was excluding some of the delinquency. Essentially, I think anybody that was 30 or 60 days late was removed from that report.
Yeah.
So as we dug further on the delinquency, we noticed there was more residents that needed to be removed because they weren't paying for several months.
Yeah.
Yeah. And the important thing about the occupancy too, when George mentioned a permanent loan, that's, you're getting a fixed rate loan. You're not usually able to get a fixed rate product if you're not 80 or 90% leased up. So, you're having to get what's called a bridge loan, and then you have a variable rate, and then you'll have to refinance into a fixed rate product. So it adds extra cost to the loan, extra stress to the deal. So we really wanted to minimize our downside and stress to the deal by getting it to 80 to 90%. So part of our negotiation with this developer, we negotiated that our property management company would take over before we actually bought it. So,
That's great.
Okay, yeah.
That's great.
So we can control that. Our property management company can control that lease up.
Yeah.
And we already own, over 1,000 units in the Dallas area, so that they're already managing, and they've done lease ups before. So the owner was open to it. Their property management company they were using wasn't very good, so it was a blend of, them needing to sell, them being out of state, having this property management company that wasn't doing well, so they were able to accept that. We negotiated some seller financing in there. He's leaving $3 million in the deal at 5%. So nice
Great.
seller financing chunk there.
Yeah.
But that all happened because there was this need for him to sell. That the deals that are happening right now, there has to be a story. It's not, I want to make as much money as I can and move on to that one. It's hard to make a deal happen at that. There has to be some sort of motivation from the seller to want to, whether they're retiring or whether they're their kids don't want anything to do with real estate, or if they're in trouble where they have investors in there that want out, different equity partners, or their loan is coming due. So that's kind of what we're looking for too, is like a story of why, a good story of why they're.
I think
Go ahead.
in these times, like, you got to get creative, right? You got to try to structure seller finance, like Brian mentioned.
Yeah.
You got to, we started this conversation the beginning of this year with the seller, and they weren't quite as motivated back then. So we had to stay patient and follow up until finally now they're motivated, right? And they're willing to accept our terms. There's another one we're working on right now where the lender, so they've built the first phase and they've got the second phase that they're going to start working on, and the lender will no longer release draws because they don't have confidence in them because it's stalled out or whatnot.
Yeah.
So we're trying to see how we can structure something where we come in, give the lender confidence that, hey, look, there's somebody here that's going to buy this, release the draws so we can take over. And
Wow. What,
Go ahead.
Brandon?
I was gonna say, what is where, as y'all kind of finding these deals, how do you find the motivation? Is it once you start having the conversation with them initially, or is it or is there some way for y'all to be able to detect this motivation or this pain that they're feeling prior?
I think that's like when the first time, whether you get a deal directly from the seller or from a broker, the first thing you're asking is for the financials and why they're selling. That's one of the first things I'm asking is why they're selling. What's that reason? And that can help you paint the picture out. Okay, the property management company is not good. We really need to dig in there. We're going to dig in there regardless, but it's good to have your sensors up on that. And then, finding that motivation is usually just by asking, whether it's from a broker or the owner directly. And we're finding deals both ways, reaching out to developers, reaching out to owners of older property. We're talking a lot about developers, but we still buy C class and B class and A class. It's just finding the window in the market, what that opportunity is. You know, 4 or 5 years ago, there was a lot more opportunity in C class properties. It seemed like now everybody is going after C class, and the cost of borrowing is harder there too. So we're the window right now is on the developer side of things. But if there's a good story behind a B class or a C class and the returns are good, then we're still gonna dive deep there.
It's interesting how that's been shifting.
Are you guys within the credit portion of the due diligence? What does that look like? Is it hey, we've come up with $365,000 worth of things. We'd like to get a credit for this. Is it almost like oftentimes I find it in the residential and small multifamily world, like it's like a song and dance of like knowing the seller. How do I approach this? Like, is it like you guys have an agent and they just call and get it done? Or is it like, hey, here's what we saw and here's the exact this, and this is happening, and this is what we feel is like, and that's then some sort of renegotiation. What does that look like on that end? Getting that dollar amount.
Yeah, great question. Especially on this one. So usually I like to have all the details, right? If I'm going to come to somebody and ask them for a credit, like I don't want to just be like, hey, give us a credit because we found.
Pulled this out of my butt.
Yeah. Yeah.
Yeah.
So we put together a pretty detailed explanation, backing everything up, backing up the numbers, pictures, estimates, all that stuff. And apparently on this one, it was not good.
Yeah.
It was almost too much information, and it seems like it almost would have been better to just have a conversation about it and then maybe backed it up with the details afterwards.
Almost just ask for the number and then see what he said, or
Something
or
like
she.
that, and just first time that's happened to me. Usually the detailed part of it is better, but
Helps.
yeah, I
What was their reaction in this specific case? Was it like, oh no,
they freaked out.
Oh yeah.
They freaked out.
Yeah.
And
Well, did you go pictures and then they freaked out? Then you said number, or was it like number pictures? Like,
it was all together.
all
Yeah,
the same
all the
thing,
information. Yeah.
Sometimes I do a song and I'm like, do I say, hey, we're gonna be asking for 10K, or here's the pictures, and then like get them start wrapping around their head. There's it's a song and dance, and it's a very fine line of like, when do I communicate information? The specific seller will dictate that. I think you guys know as well. It's very, as data driven as we want to be. In the real estate, it is very relational, and you might have a guy who's 85, and like you have to go have coffee with him to communicate information.
Yeah, for sure.
Or it's like, hey, there's young guys like you, and just give them the facts and send them an email, and they'll be like, yeah, it sounds good. So I think would you guys agree it depends deal to deal based on the seller?
100%.
Yeah.
Yeah, I mean, being on the seller side of some of those deals where I get asked for credits, I think letting them know, like, hey, we went through the due diligence, we found some things, might be asking for either you to fix it yourself or give us a credit. I think giving them the option of both is a win-win, like for them and for you. Hey, you can make these repairs or you can give us a credit.
Yeah.
And giving them a heads up, hey, we found some things, but we're going to follow up and send you a detailed report with pictures versus someone who walked in and said, yeah, these are going to need some work. We need $50,000. Like, I almost don't want to do a deal with that person after they just said like an arbitrary number and they said, yeah, they're kind of rough looking, I think we're going to need just a random.
So it gives
number.
you the bad vibe. To you, it's probably saying, hey, I just want money off this deal.
Yeah.
But if someone that comes in and goes, can you replace this or fix this? You're like, they legit just want a good product when handed over. And that speaks to that, correct? That you want someone that's like, I actually want the property to be fixed. I'm not just looking to. They call it trumping because Trump would always get into a deal for $5 million and be like, well, I really know I'm going to get it for $3 million, and then you get the seller's already spent that money 90 days down the line. You go, I got to extend a little further. You get them now that they're going to sell regardless, and the buyer knows that, and you're like, and they kind of take advantage of it. I mean, it is a way to go about business, but I like how you said that. How it's communicated and offering the options is huge. So, person, if you're listening, like, communicate that information effectively.
Sure.
So you guys found this deal. Was it just a follow-up game to find it?
One of the investors in the deal is also a broker. So
Okay.
He invests. I don't know how much he had in the deal. There's a small amount of investors in it, and he was in touch with our director of acquisitions. So
That's great.
we have a director of acquisitions and senior underwriter. All he does is find deal. Like, his sole job is finding deals, whether that's from brokers or from owners, and then he also underwrites for us too.
That's
so
great.
He's doing that process. Before, it was us taking broker calls, sending mailers or whatever, to find deals. But now we have someone dedicated to just turning over those rocks, and not only turning over the rocks, but underwriting them. First doing the back of the table napkin, and then doing deep dive
Before bringing you just some piece of crap.
Yeah, exactly.
Yeah.
Which we get pieces of crap brought to us all the time. but
Yeah.
Right.
Just weeding through that.
Let's let me ask you guys this. Are you, I guess for this deal, there's a port, like, are you now like, all right, we're through, like, I guess the physical due diligence, like, hey, we're looking for investors now? Like, is it like, hey, we already have our investors lined up? Or is it like, person on the other side of this podcast listening, like, hey, we could potentially need you? Like, what's the vibe like for you guys going into the next part of this deal? And then that'll transition us into the next, which is like, hey, one, do you need people to invest, and who do those people look like? And I'd like to dive in a little bit to that. Like, what does the next, I guess, 90 days of raising funds look like? Or
Now it's on.
Okay.
Now due diligence is on, and we're opening up to investors. When you're at the due diligence, it is kind of a fine line of we start telling our our repeat investors, hey, we've got this deal we're really excited about. Here's some initial numbers. We'll start talking about the deal, and people say, yeah, okay, put me in for 100,000 or count me in for 500,000 here, and then once we're through due diligence, then it's okay. We really need to start raising capital. While you're in due diligence, it's kind of simultaneously. We're talking to lenders, see if we can get some hard quotes. Talking to some investors, seeing if we can get some commits there.
Getting the word out.
If those guys wouldn't have accepted those credit, and if they wouldn't have accepted some of those things, we might have had to walk away, and
right.
all that time was for nothing. So
you're going back to those people that know, like, hey, I'm potentially ready, but if it falls through, it's fine. So you're hitting those old people, those old investors first. Then what does it look like as far as investors? Like, do these people just need to have 100K liquid? Doesn't matter who they are. Is it like, hey, we take specific people? Like, especially, I think I'm trending this towards like somebody listening, they have 100, 200, 300K, 50K. Like, are those the type of people you would potentially be interested in talking to about investing in your projects?
Yeah, 100%. Yeah, and you said earlier 100 to 200K to take down some of those small multifamilies. I don't know what 100 or 200K you can buy for like buy 10. You can't. It's hard that you can't really go very far with 100 to 200K if you're doing a deal on your own, unless you're buying single families. So for an investor to invest with us, they have to be an accredited investor. So that means they're making $200,000 a year or more, or them and their spouse are making $300,000 or more, or they have a net worth of $1 million. So you can it's either or, the income or the net worth requirement, and that's because the SEC set that requirement. If you're making that much money, you should know what you're doing with your money. Yeah. And so we can openly talk about deals. You can do deals that don't meet that requirement if you're not talking about it in public. So those are the types of investors. Yeah, we're looking for investors that want to invest passively in real estate, get the benefits of real estate, but not do all the work. They're climbing the corporate ladder. They're a lot of physicians and dentists invest with us. Whether they own their own practice and own the building, or other business owners too who want that depreciation. This one has pretty good, but we're doing a cost segregation on it. And we share the depreciation with our investors, and they're getting, for every $100,000 invested, they're getting about like a $40,000 loss for 2024.
That's great.
So pretty good. They're phasing out bonus depreciation right now, but we'll see what happens election year if that starts coming back in.
Hopefully.
Fingers crossed.
Need that, May.
But those are the type of investors we would invest with. Most of them are pretty diversified. They invest in stocks. They invest in a lot of business owners, it seems like, that are established in their business and want to diversify.
We take retirement funds, so 401k or IRA. You can do a self-directed IRA.
Yeah.
What is the typical payout look like for an investor? Is it monthly distributions, or is it quarterly distributions, or what does the distribution look like for a typical
we
investor?
try to, for us to do a deal, it has to meet a lot of requirements. We're trying to net our investors 2x in 5 years. That's 20% average annual return over 5 years, not including tax benefits. I would think that's a good requirement. Maybe a little bit less, maybe a little bit more, but for the cash flow, it just depends on the deal. This one is cash flowing pretty nicely because we're partnering with the housing corporation. We're not having to pay property tax. So that one's going to cash flow.
Especially in Texas.
Yeah, 7%, 8%. We'll do
average is between 8 and 9% average.
Yeah, we'll do quarterly distributions on that, and then your big kicker is when you sell the property. You force it's same thing like a business. The great thing about the multifamily properties, you're running it like a business. Each apartment is its own business. By increasing your business's valuation, you're increasing the bottom line. Same thing with apartments. We're pushing that NOI, where then again we can sell it in 5 years, where we can get that big kicker at sale from forcing the appreciation, coming in, improving operations, and improving efficiencies, where the next buyer can come in and.
So that's the ultimate goal for you guys. It's not hold it for 20 years. It's like, hey, how can we get in? How can we optimize this? And then how can we cash out and then get our investors back their money? Is that correct?
Yeah, that's usually where you find your maximum returns too. After 5 years, your returns kind of diminish. You're not, maybe you're getting 15% return on year 6 and year 7, because your big value add is taking it from the owner and coming in and doing this, value
Right.
add component. Same thing like a flip. Your big value add is you're flipping, you're adding all this value and then you're selling it right then. Yeah, you could probably hold it and still make a solid return, but you're not getting that huge return on
Your
on
return
investment.
is probably going to lower
Yeah.
each year after you get past that 5 year.
And that's kind of what our investors are looking for. Right? They're used to the 5 year term, where they're in between retiring, or that's how they invest in that 5 year horizon. I think maybe as we get older, maybe we'll hold longer, and we get more institutional type investors that want to hold for 10 years plus. Then we'll structure those deals. We also have a fund that we're doing. Like if you're familiar with hard money lending, it's similar to that. That one's doing monthly distribution. So that's another kind of vehicle we just started at the beginning of this year, where we're not doing any deals, but we can still find ways to make money, and that's lending out money. People are always going to need capital for their real estate deals. So
Totally.
we started a fund last year to do that. So where investors can come in with us and get monthly cash flow distribution. It's not upside, but
Right.
More of a cash flow play versus the
Right.
and you have, I think for investors, there's so many different reasons for it. Just same thing like with a seller. There's so many different reasons for investing, whether you're trying to retire, whether you're trying to just grow your equity. You're trying to snowball that. Some people want the cash flow because they're trying to replace income, or they're trying to supplement their income. So there's a lot of different types of investors and types of investments we're looking at.
Yeah. Why do you think investors? This might be a weird question, but why do you think investors say no to investing as a limited partner in a deal like you guys have? And what would you say to those investors that? I guess
Kick rocks. No,
Yeah, I mean, they're probably trying to be active, right?
Yeah.
And if
It seems like that,
If you want
right?
to be an active investor, that's fine. You can go out there and do the work. But if you're looking to have passive income, which I would hope most of us are,
Yeah.
this is a good tool to do that.
Yeah, I'd say that's the most common. Is they just want to be active, or they think that they're going to make more in the stock market or somewhere else.
Yeah.
Yeah.
Like they're just looking at the returns and they think they can beat those returns in a different vehicle.
Yeah.
Right. Makes
Just
sense.
by this point, you guys have had a pretty proven track record of success for your investors. When I first got in the real estate business, and even now and for the next little bit, like I am going to be more of an active type of investor. But as of recent, I recently started investing in the stock market. Never thought I'd do that. I thought it was going to be real estate till the day I died. And I'm like, and I started talking to some really smart people, like probably good to be diversified. And like doing funds like this for me sound more attractive the older I get. You know what I mean? It's like, oh, I don't have to take potentially like all the risk myself and like all the, it's nice to think about. And I love, I was full real estate. And then I went, all right, like what are the benefits of the stock market? And so like, let's talk like somebody listening to this, what are the benefits as opposed like passive like you guys versus active? I think there's benefits to active and passive. Bigger Pockets just did an episode on this, on the benefits of active and passive. What would you say is a difference between active real estate and then like just being passive with you guys? And they're pretty obvious, but I'm just
I'd say active real estate is a job. If you're trying to make it real estate a business for yourself, or you're trying to replace your job, active is like pretty much the way to go. If you're young and you're trying to replace your income, then right away, then that's probably the way to go. Versus passive, it's you're supplementing your income, you're increasing your equity, you're still doing that while you're focused on something else, whether that's family or that's your business or that's climbing the corporate ladder. You're investing in real estate without having to hunt and find, talking about the benefits. As an active investor, you have to hunt and find deals, and then you have to underwrite those deals once you find a good deal. Or how do you know it's a good deal? You have to underwrite it, and then you have to get approved for the loan. You have to get property management set up. You have to account for CapEx, construction work, anything going wrong in the part, the real estate. You have to account for the legality of it. You know, are you accountable for if something happens if the resident gets hurt? Are you accounting for your legality at sale? And then you have to go through the sale process too when you're ready to exit. So as a passive investor, you're not doing any of that. You're vetting the deal, making sure the underwriting assumptions are correct. You're vetting the sponsor, making sure that they have the track record, that they've done it before, and they're not underwriting like we're talking about it earlier about assumptions and deals, and making sure they're not underwriting for 9% increases in rents. You know, making sure they're being conservative. NWA increased, 10% the past, 10 years, but that doesn't mean that that's going to happen in the future.
Yeah.
So that's kind of your main job as a passive investor. But once you do that, then it's okay.
Here's my money.
Yeah. When are my cash flow distributions? Keep me updated on progress on the property. Maybe send me pictures or monthly updates, and then my tax documents. Also, the tax the tax benefits are great. A benefit of being an active real estate investor is you can qualify as a real estate professional. So there's a ton of good tax benefits and qualifying for a real estate professional, being write-offs, being able to offset your active income with your passive income. So that is harder to do as a passive investor. You can, if you get the right CPA, you can qualify for that. You're saying you're spending enough time vetting the deals, vetting the sponsors. We have a lot of professionals that get their spouse to qualify as a real estate professional. Yep. So that's another way to look at that. So
you hit the nail on the head there. I mean, it was perfect. George, do you have anything to add to that?
Just quickly, right? Like most of our investors are busy professionals, or they own a company. Like, they don't want to do everything that it takes to be an active investor. And a lot of the times, being an active investor is not as easy as it seems, right? There's a lot of work that goes into it. It's not like the shows that you see, where every deal you make a bunch of money as well, right? I mean, you could also lose money in real estate. So
for sure.
If you don't want to get the education and get the knowledge, then invest passively.
I guess the passive investment too, the only really risk, I guess, is the capital that you put in, right? Essentially, I mean, tell me if there's any other potential
That's
risks.
100%. You're limited to, your liability is limited to the amount of capital you invest. So you're investing $100,000. That's what's at risk. Nothing above that, because you're a limited partner in the deal. So the downside is, if you want to be active, you have no say in the deal. You don't say when the rents increase. You don't say when we switch property management. You have to have faith in us. We can't have 100 investors saying, "Oh, we should have it at 1575. I don't know, let's get it at 1600." But it's also for their protection, because if something did happen, I had no say in I'm right here. I'm a limited partner. I had no say in anything what the deal did. So that's the caveat there.
Yeah, if you're a money investor, you're there to be money, not anything else. Totally get that. We're gonna jump past some sections here, because we've done such a good job of like explaining in depth on some of these things. You guys have done an awesome job. What I want to talk about is, before we go, is there any deals right now that someone listening and they're a business owner or whoever they are, that they can invest in, and how do they do that? How do they go about doing that?
Yeah, just reach out to us. You could reach out to me, Brian, Brian, at elevatecig.com. And then we'll make sure you're accredited, and we'll talk about either the fund or our Dallas deal, depending on your time. I like to set up a call with my investor relations, Mina, like to talk about goals, because maybe you don't have 100,000 or 50,000 to invest right now, but maybe you do in the future. So we talk about that, or Mina's very good at setting those calls up too. But if you have capital gains right now, or you have money sitting on the sidelines, I think it's a great, this one's a really good one to invest. So just
end of the year is always a good time.
Yeah.
You can soak up some of that depreciation.
So right about the time this podcast, it's 10/8/24 right now. It'll probably be released mid-month. If you're listening, contact Brian and get in contact with him if you're looking for some of those benefits, looking to invest a little bit. I think you guys have a very proven track record, and I want to use this platform as a way to broadcast that a little cast that net a little further for you. Do you usually see people, it's like 50, 100, 150, 200? That's kind of the
I think our
increment.
average investment is like 145. And
Okay.
that's just because we get a lot of $100 to $50,000 investors, but we also have several that'll invest $500,000 or $1 million
Yeah,
in the
yeah.
deal, so it'll bring that average up. But
Right.
we say $100,000 for our minimum, but usually we'll take $50,000 investments for first time investors.
No.
Let's transition into kind of a macro and micro, like nationally. It may be a little repetitive, but like what are we seeing? I guess because you're in different markets, you guys are both in different markets. You see a picture that Brandon and I don't get to see. We're hyper focused on NWA. You guys get to see nationally. What are you seeing nationally for best potential appreciation in the next, let's just say 5 years? Or are there other markets you see that could potentially be better than Northwest Arkansas or just as good? It's okay if you say
Yeah, I mean, I think, I mean, Northwest Arkansas is one of our top markets.
Right.
It's one that we think is going to continue to appreciate. But I think there's some other Midwest markets that are undervalued,
Mm-hmm.
and we're starting to see some of that. You know, we're invested in South Dakota, a couple deals there. We really like that market. We bought a deal in Kansas City.
Mm-hmm.
Late last year. That's another market that we like.
Yeah.
You know, Dallas, where I'm at, I mean, that's a great market, has been for years,
Yeah.
and it continues to be pretty strong. I mean, I feel like every week there's a new corporate headquarters or something happening in Dallas.
Mm-hmm.
So I don't think that one's a surprise, but it's there.
Yeah.
And then there's, look, Florida had a great run. And I feel like that run is somewhat coming to a freeze for a bit.
Mm-hmm.
The insurance is what's getting really tough there, and
Yeah.
we got another. As we were speaking right now, there's another hurricane going that way. So I mean, it's only going to get tougher.
Yeah,
Sure, yeah.
those are Midwest markets like South Dakota, Kansas City, Northwest Arkansas, and Dallas is like our favorite Texas market for appreciation. Houston, you have to be careful there. There's some really good markets, and there's some not so good markets. Austin's kind of overheated, where you're paying for the name and
Yeah.
but like the announcement that we get all excited about NWA, like $1 billion home campus, but you look at Kansas City, there's a $4 billion Panasonic development going on for like car batteries. And
Yeah.
it's like that's for just one development, and then they're doing $100 million development here, $250 million development here. So it is really exciting what's going on in NWA, but there are a lot of other exciting markets too.
Yeah.
And that's kind of like back to the active versus passive. It's kind of sometimes it can be good if you can't go and touch your piece of your investment,
Yeah.
because then you start going over there a little bit too much and it becomes a job, and what you're doing may not be really your highest and best use of your time.
Yeah.
Your dollar per hour isn't probably best spent over there, but it's tempting because it's so close to you. So
Right.
sometimes investing in another market, as a passive investor,
Yeah.
I think it allows you to look at the data more too, like
Mm-hmm.
be more data driven on your investment versus like it being right in your backyard,
Yeah.
right?
Right.
There's a lot of emotion going on
Yeah.
in
For
investing locally versus not so much
Yeah.
out of state.
Yeah.
What kind of anchors do you all look for in emerging markets as far as maybe job growth or population growth over time? Is there anything specifically that you're like, if an area has this, then we're interested in looking?
Yeah, I mean, you mentioned the main two ones, right? We want to see job growth on a yearly basis. How much of that just depends, right?
Yeah.
Depends on how big the city is already, and just, and then job growth is another one. Which I mean, those two kind of play hand in hand with each other, right?
Red states we're investing in.
Yeah,
I mean, that's
landlord
like-
friendly, red states
Absolutely.
for sure.
Yeah.
I mean, we're not investing in California at the Northeast. We get deals sent there every now and then, but I mean, it goes hand. You can, if you just look at the numbers, it's very business friendly, landlord friendly. There's a lot less crime. Sometimes crime is a big thing that'll
For
say,
sure.
no, we're not. Besides the level of government involvement, crime is a big thing because that's hard to fix.
For sure.
You don't know how long it's going to take for crime to get out of a certain area, and that could be a long-term process, and it's a headache to deal with if you have to deal with it. You might have a little bit of crime, but that's hard to change the path of progress in a very crime.
Right.
It can happen, but
Yeah.
it's a lot more risky. And then the policy too. It's just like that's why short-term rentals. People are making a lot of money in short-term rentals, but there's a lot of legalities there that can change. Like they're changing that every day.
So like California.
That's like
Yeah.
not something that you can control. And we're in real estate because we want to control. We want to have some element of control,
Right.
versus.
We're dealing with so many variables already. Like the
Yeah.
last thing we need is
New
policies to
Right.
Yeah.
drive more of them, right?
There's a lot of people in California. I was listening to some episodes of Bigger Pockets, and they were like, yeah, we bought 15 short-term rentals, and they decided in that city that you can't have short-term
Yep.
rentals anymore.
Yeah.
And we didn't
Yeah.
get grandfathered in. And so it's like, literally, that's like a life-changing event. And
Yeah.
that's why I always, for people looking to invest short-term rentals here locally, I go, hey, great, love it, but like I don't feel comfortable telling you to buy $1 million home as a short-term rental. Like, let's run this as a long-term rental numbers first and how high we could potentially get there. So like at a backup, you can get most of this covered at least. Because like
Agreed, yeah.
with this area growing, when we're going to like double in population in the next however 10, 15 years or whatever, like
10 years, yeah.
there's going to be more policies with the more people. And, we're going, if we're already seeing in some of the states, we're getting shaded a little bit more liberal, and I think you need liberal as you need conservative, swing us towards the middle.
Yeah.
But some of those policies that come with the higher populations will breed not liking short-term rentals. I always like to, we're getting towards the end here, I like to integrate some sort of life question along with our podcast, because there's real estate, and we love real estate because it allows us to like do life and live a more relaxed life and live the kind of life like we want to live. And so today I wanted to ask, like, what's the power of, and each of us are George, are you married? Okay.
Yeah.
What's the power of having a wife that's on board, and what did that process look like for you guys? I know, Brian, we talked a little bit last time, but like, were they on board to start? Did you have to convince them? And then like, what is the power of having somebody that believes in you on board? George, I'll let you start.
Yeah. I mean, my wife was business partner in the beginning. So I brought her on.
Yeah,
That's all.
And, we did everything together. It was not always easy, but
Yeah.
we figured out how to work together. And it wasn't until we had children that she stepped away, but she's always had my back. We picked up everything and moved from Miami to Dallas, and she trusted in me to make that move.
Yeah.
So yeah, I know having that support is huge.
I think a question to follow up is, what would your life be like without her support if she didn't believe in what you were doing?
Oh
It just
gosh.
sounds like a living hell.
Probably wouldn't be married, that's for
Yeah,
sure.
yeah.
And I probably wouldn't have made it this far, honestly. Yeah.
Yeah.
It's amazing.
Brian,
Yeah.
would you be where you are without?
Yeah, who knows where I would be? Maybe I'd be in a different city or state. I had another opportunity to leave Northwest Arkansas to open an office in Nashville, Tennessee, and I turned that down because of her.
Yeah.
I think if you listen to the last podcast, I mean, I had 200 units before I even had a business card or a
Yeah.
website, and I got a lot of those units. She would drive me around crappy looking apartments, and I would take pictures and send them a letter saying we were interested. She would
Yeah.
help me draft them up. I got her listening to podcasts. She would go to seminars across the country with me. So
That's all.
my whole goal was to retire her. So I
Mhm.
had a vision of, her running the house and raising our family.
Right.
While I focused on the business, and it's now we're there. We have an 18-month-old boy that's like amazing, and I know he is like sweet and awesome because she is dedicated to
Right.
him and dedicated to the house, and so it's really nice seeing that
That's amazing.
happen now
Yeah.
too, where she can be focused on that and I be focused on real estate.
Yeah.
That's
So
amazing.
Brian just reminded me of not every night, but like every week, at least once or twice, we would go at night and put out bandit signs. You know, so you can drive and not be the one running and putting out the bandit signs. And
That's amazing.
It starts somewhere, and I think to the listener listening, and you don't have the wife, or if you're a girl and you don't have the husband or the person supporting you, it's think about who is in your sphere. And then, like, are they supporting what you're doing? Do you have someone? You need to at least have some sort of sphere of influence around you if you're not married yet or have a significant other. You need to have some type of support around you, because it's too hard to just, like, be a bulldog and do it yourself. You're eventually going to burn out. I did that at some point in my career, and literally got put in the bed because of adrenal fatigue because I was pushing so hard. And so you have to have some support system around you. Brandon, would you say the same thing? I know the people listening have heard us talk about like how important our wives are, but I'll let you.
Yeah, 100%. Similar to these guys too. I've had my wife over the years. We've been together, I guess, a little bit over 3 years now, so not a ton. But in that time, like she knows now as we're driving, anywhere that we're driving in Northwest Arkansas that we're not typically in, like. If I'm always visual, I'm sure y'all are too, and if I see an apartment or a duplex or something that maybe looks run down and might be an opportunity, she's like already on the phone, pinning it on the map, taking a screenshot, sending it to me. Like she knows the deal. So it's huge to have that support. And then I don't have to, she's got the trust that I don't have to necessarily. We do talk through everything and all the deals that we do together, but I don't have to necessarily worry if she's going to be in or not. She trusts, my, the things that we're doing and stuff like that, which is awesome. So, and we've got a similar goal kind of trying to retire her and let her kind of be over the household and me kind of over the business and stuff like that. So love that. I share a lot of that as well. So.
Thank you guys for coming on. We did literally such a good job. You guys did such a good job of expanding on your topics. You're so knowledgeable about the work you're in that we didn't get to hit some of our points because we elaborated so well. And I think audience members will love that we dove so deep into some of these topics. I want to thank you guys both for your time. As always, I know your time is money, and so I really appreciate that. We're gonna hit sponsors here in a minute, but I want to say also, like, Brian, I know you said earlier in the podcast how they can contact you guys. Use this as a point, Brian and George, to how people can reach out to Elevate.
Yeah. Email me, brian@elevatecig.com, and be happy to jump on a call with you about investing, what you want to do, your investing goals in real estate. So
Totally.
Yeah, you can check out the website too, elevatecig.com. A lot of information on there.
Yeah.
Yeah.
A lot of good resources on the website too.
Awesome. Thank you guys for listening. Episode 37 NWA Investing Podcast. Love you guys.
Love you guys.